Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. We are now well into the third quarter earnings season for U.S. equities, and so far the omens have been positive. Among S&P 500 companies, we are seeing a higher number than average beating earnings estimates, and doing so by a wider margin. At this pace, the index is on track to report the third highest earnings growth since Q3 2010, when the U.S. economy was moving out of the recession caused by the global financial crisis. The growth in earnings and the size of positive surprises has been led by the financial sector, and in particular, banks, who of course are likely to be beneficiaries of a rising interest rate environment. However, for the moment, they have been capitalizing on buoyant stock and fixed income trading, new issues demand, and record levels of M&A activity. For example, Goldman Sachs reported quarterly revenues of $5.61 billion. Investment banking was responsible for well over $3 billion of that income, though the bank's consumer and wealth management business generated $2 billion of income in a quarter for the first time. Those kinds of numbers helped the Wall Street Bank blast past earnings estimates of $10.11 per share to deliver massive earnings of $14.93 per share. Of course, it's early days and less than 10% of the S&P 500 stocks have reported Q3 earnings thus far, though 80% of those that have reported have beaten expectations, according to data compiled by FactSet Research. On average, those earnings are beating expectations by a margin of 14.7%, well above the 5-year average earnings beat of just 8.4%. S&P 500 companies that have reported Q3 numbers thus far are also beating on revenues. 83% of companies reporting have posted positive revenue surprises, which on average are 3% higher than forecast. That's double the 5-year average for revenue growth of just 1.4%. Amongst all this data, is it still possible for retail investors to spot winners? After all, Wall Street analysts and traders have been poring over the data for the last 6 weeks or more, and we might expect that all the opportunities have been identified already. The truth is that retail traders can uncover winners amongst the earnings data blizzard, though trading stocks purely on earnings is a high-risk strategy. So what should retail traders be looking for when assessing an earning opportunity? Let's look at a textbook example in the shape of aluminum producer Alcoa. The stock is not an S&P 500 constituent, but for many years it's been seen as a name that helps to kick off earnings season. Following its Q3 earnings last week, Alcoa jumped by 15.23%, taking its weekly gains to 21.66%, its quarterly gains to 62.13%, and its year-to-date gains to 142.95%. It would be fair to describe Alcoa as having momentum, or in other words, its share price is sensitive to new information such as its Q3 earnings. That sensitivity can be expressed through the stock price on both the up and the downside, of course. However, if we look back over recent weeks, there were several clues that Alcoa could surprise to the upside. For example, on the 28th of September, Morgan Stanley raised its price target on Alcoa to $62 per share, up from the prior target of $51. That was a near 20% increase to the price target, which analyst Carlos de Alba justified by calling Alcoa a top pick amongst mining stocks. He added that the stock was then trading at just 2.8 times its enterprise value, based on earnings forecast for 2022, compared to its historical average of 7.5 times. Alcoa had also recently announced that it was restarting its aluminum smelting factory at Alumar in Brazil, which had not been operational since 2015. Why was Alcoa rebooting this mothballed facility after almost 6 years? The answer can be found in this chart of the percentage change in aluminum prices over the last 5 years. The metal's price has effectively doubled since the coronavirus outbreak, and we have seen further price rises in recent weeks as well. In summary then, in Alcoa we had stock with price momentum that was attracting very positive broker comment, and which produces a product that is high in demand and whose price is rising substantially. Doing some research and background reading on stock can help traders to get to know a business and to become familiar with how its price reacts to new information, and that knowledge can translate into winning trades and investments. That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.